BioGreen Farms is a thriving organic vegetable producing company. The company has garnered a loyal customer base and consistent profitability. Now, faced with increasing demand and a growing market for organic produce, BioGreen needs to expand. Mr. X, the financial manager of BioGreen Farms, is required to take three crucial decisions across different areas of financial management, requiring practical calculations and strategic analysis. So, financial management, it is allocation and acquisition of funds. Talking about the objectives of financial management, it is profit maximization and wealth maximization.
Three crucial decisions on which Mr. X must work. Those are investment decisions, financing decisions, and dividend decisions. Where to get money from is financing decision. Where to invest money is investment decision. And how much to distribute among shareholders and keep them satisfied is dividend decision. Now to expand, investment decisions would help. So there are only two alternatives. First alternative is invest in organic fertilizer production. Initial investment is $5 lakh for equipment and setup. Projected cash revenue inflows are $7,50,000 for 5 years each. Operating costs are $1 lakh for materials and processing, whereas discounting rate is 10%. In alternative 2, initial investment as $3 lakh for delivery trucks and marketing campaign. Projected cash revenue or cash inflows are $11,25,000 for 5 years each. Operating costs are $2 lakh per year for delivery, logistics and marketing, whereas discounting rate is 10%. Let's see which alternative is best suited for BioGreen Farms. Alternative 1. Annual net profit after costs actually states that it is only $6,50,000, whereas in alternative 2 it is somewhere up to $9,25,000. There is a table showing the present value of the year cash flow and discounting factor. NPV, which is equal to PV of inflows minus PV of outflows, has been done in both the cases. The first result states $19,63,500 and the second result states $32,05,750. Based on NPV, expanding the organic vegetable delivery program has a high potential return, which is $19,63,500 compared to organic fertilizer production, that is $32,05,750.
Since Mr. X has already decided in which project to invest for the BioGreen Farms, now is the time he should think about from where to acquire the funds for this investment. This is when financing decisions comes into play. Financing decisions are concerned with capital structure. It refers to the way a company finances its long-term operations and growth. It is essentially a mix of debt and equity financing. There are some various sources by which a company can finance itself. Apart from equity and debt, we also have retained earnings and preference share capital and loan from financial institutions. Now have a look on the screen. The present structure of BioGreen Farms. So Mr. X has three alternatives to finance BioGreen Farms. First one is equity, second is debt, and third is preference share capital. To see which alternative is best for BioGreen Farms, Mr. X needs to evaluate the optimal capital structure. An optimal capital structure would be one that maximizes the wealth for the company. There are three approaches to find out an optimal capital structure. First one is EBIT, EPS, MPS analysis. Second one is break-even point analysis, and third one is indifferent point analysis. First, we will have a look on the EBIT, EPS, MPS analysis. For this, I would want you to know about the basic terminology. Talking about EBIT, it is earnings before interest and tax. It is the operating profit of the company. It does not take account for the financing and tax decisions of the company. So next is EAT, which is earning after tax. If we deduct interest, tax and preference dividend from EBIT, we will get EAT, which is the net profit of a company. There are two more very crucial concepts in financial management, which is EPS and PE ratio.